Episode 6, The Stress Test, series finale. In the fall of 2008, roughly 3.4 million Americans were within 5 years of retirement. By the time it was over, their retirement accounts had lost an average of 31%. For many, that wasn't a number on a screen. It was years of their life, years they'd already spent, years they couldn't get back. Some of them went back to work. Some of them never retired at all, not because they didn't save enough, not because they made reckless bets, but because nobody ever showed them how to build a portfolio that could take a hit and keep standing. This series was built so that doesn't have to be your story. Over the last 5 episodes, we built something together, piece by piece, a framework, a philosophy, 3 portfolios designed to survive the worst that markets can throw at them. But designing something and proving it works are 2 different things. Today, we prove it. We're running all 3 portfolios through the worst economic disasters of the last century, and we're going to watch what happens when everything goes wrong. This is the finale. This is where the math meets the moment. Here are the rules. Starting balance, $500,000. Annual withdrawal, $20,000, adjusted upward each year for inflation. This represents a 4% initial withdrawal rate, the standard benchmark in retirement planning. Rebalancing, once per year, back to the original target allocation. And the most important rule of all, no panic selling, no matter what. The investor in this simulation is the person this series was built for, the calm adult, the one who built the plan, trusts the math, and doesn't abandon the system when the world gets loud. Let's go. September 15th, 2008. The 4th largest investment bank in America dies in a single weekend. What follows is a financial earthquake. The S&P 500 drops over 50% from its peak. Credit markets freeze. Banks that were supposed to be immortal start failing. The word collapse stops being a metaphor. The fortress does what it was built to do. The stock allocation drops hard, but the gold allocation, the shield we put in place in episode 3, rises. The bonds hold. The cash is untouched. The retiree withdraws from the buffer. Not a single share of stock is sold at the bottom. Maximum drawdown, 12 to 15%. It bends, it doesn't break. The balance machine takes a real hit, 20 to 25%. That's the kind of number that makes people call their financial advisor at 2 a.m. But the structure holds. The buffer absorbs the withdrawals. The gold offsets some of the stock decline. The retiree holds the line. The growth engine is devastated. 80% in stocks during a 50% crash means the portfolio drops 35 to 40%. On $500,000, that's nearly $200,000 gone on paper. This is the moment where most people quit, where the plan dies, where decades of discipline evaporate in a single phone call to a broker saying, sell everything. But our investor doesn't sell because they built the plan. They understood the math. They knew this moment might come, and they held. Within 3 to 5 years, all 3 portfolios have recovered. The fortress recovered first because it had the least to recover from. The growth engine recovered last but ended highest because the same volatility that made the crash painful made the recovery powerful. The difference between these 3 outcomes wasn't intelligence. It wasn't timing, it was patience. March 2020, the world stops. The S&P 500 drops 34% in 23 trading days. It's the fastest crash in the history of the stock market. There is no precedent, there is no playbook. The global economy is being shut off like a light switch. But here's what 2020 taught us that 2008 couldn't. The fortress barely registered the event. Single-digit drawdown, recovered within months. The balance machine dropped about 15%, fully recovered before the year was over. The growth engine dropped 25% in weeks and recovered everything within 6 months. 2020 didn't test whether the portfolios could survive. It tested whether the investor could sit still for 6 months. That's it. 6 months of discipline was the entire price of admission. The people who sold in March and waited until things calmed down missed one of the greatest recoveries in market history. They didn't lose money because of the crash. They lost money because they abandoned the plan. 2022 was a different kind of pain. No single catastrophic day, no Lehman Brothers moment, just a slow, grinding erosion. Inflation hit 40-year highs. The Fed raised rates aggressively, and for the first time in a generation, stocks and bonds fell at the same time. The traditional 60-40 portfolio, the backbone of mainstream retirement planning, failed. The thing that was supposed to protect people when stocks fell also fell. The safety net didn't just stretch, it snapped. So how did our portfolios do? The fortress held up precisely because we didn't trust bonds alone. The gold allocation, the insurance policy that the moon boys overhype and the mainstream ignores, did exactly what it was designed to do. It rose while bonds fell. It zigged while everything else zagged. The balance machine told the same story. Gold and inflation-protected securities absorbed what traditional bonds couldn't. 2022 was the validation of every argument we made in episode 3. Gold isn't there for the good times. Gold is there for the specific kind of bad time that nothing else can handle. And 2022 was exactly that. Let's pull the lens back further. 1929, the Great Depression, the worst financial disaster in modern history. Markets lost nearly 90%. Recovery took a quarter century. In this environment, only the fortress, with its heavy cash and bond buffer, would have reliably funded a retiree through the immediate aftermath. But even here, the rebalancing mechanism was silently, automatically buying stocks at prices the market wouldn't see again for generations. 1973, stagflation. The economy stalled, inflation surged, bonds were crushed, stocks went nowhere for years. And gold, in the asset most people dismissed, had one of the greatest decades in its history. In this environment, the gold allocation in all 3 portfolios would have been the best performing component by far. 2000, the dot-com bubble. Technology stocks lost nearly 80%. But the broader market, the total market index we use in all 3 portfolios, was better insulated. And gold, unloved and cheap at the turn of the millennium, spent the next 10 years quietly climbing while tech recovered. 6 crises, 100 years, 3 portfolios. Every single one survived, every single time. Not because the portfolios were magic, but because they were built on the one principle that never changes. Now zoom out. Every single crisis we just lived through, look at them from here. From down in the middle of it, every crash feels like the end. The headlines say it's different this time. The experts say the system is broken. People sell everything and swear they'll never invest again. But from up here, they're moments. Painful, important, terrifying moments. But moments. The market has survived 2 world wars. It has survived a Great Depression. It has survived pandemics, banking collapses, oil embargoes, currency crises, housing bubbles, political upheavals, and every doomsday prediction ever spoken into a microphone. Not because the market is indestructible, but because the market is people. Millions of people waking up every day, going to work, building things, solving problems, creating value. And that human engine doesn't stop. It pauses, it stumbles, it sometimes falls to its knees, but it gets back up. It always gets back up. The market has never failed to recover. The only permanent losses belong to the people who quit. The portfolios we built in this series were never designed to avoid the crashes. Avoiding crashes is impossible. Anyone who tells you otherwise is selling something. These portfolios were designed to get you through the crash without forcing you into a decision you'll regret for the rest of your life. The cash buffer means you're never forced to sell stocks during a downturn. The gold shield means you have something holding value when the traditional safety nets break. The stock engine means your money is still compounding across the decades that actually determine your retirement. And rebalancing, the quiet discipline that nobody talks about, is the habit that keeps the machine calibrated through every cycle, every crisis, every moment of doubt. That's the system. That's what we built. Not a prediction, not a gamble, a structure. 6 episodes, 1 story. Episode 1, we started the conversation. Stocks versus gold. We discovered they're not rivals. They're partners with different jobs. Episode 2, we met the real enemy. Inflation, the invisible force that makes doing nothing the most expensive choice of all. Episode 3, the shield. Gold at the right dosage, not a get-rich scheme, a keep-what-you-have plan. Episode 4, the engine. Total return. We let go of the dividend fantasy and embrace the math of real long-term growth. Episode 5, the blueprint. 3 portfolios, fortress, balanced machine, growth engine, each built for a different person, a different chapter of life. And today, the proof. A century of evidence that this system holds. This series was never about making you an expert. It was about making you calm. Calm enough to build a plan, calm enough to trust the math, calm enough to hold on when everyone around you is letting go. You don't need to be a genius to retire well. You just need to be the calm adult in the room. If this series gave you something, a framework, a shift in perspective, one idea that made money feel less confusing, then it did its job. And if someone you care about is approaching retirement without a plan, send them episode 1. Share it. That conversation could be the one that changes their next 30 years. This won't be the last series we build. There's more to talk about, more myths to test, more math to run. Subscribe if you want to be here when it starts. Drop a final comment. Tell us which portfolio you chose and why. Tell us what topic you want next. Tell us if we change your mind about anything or if you still disagree. Thank you for watching. See you on the next series.